You hear it all the time, right? Bonds are the bedrock of a stable portfolio. But what does that actually mean? Well, today we're going to pull back the curtain and break down exactly how they work, what you can earn, and most importantly, the risks you absolutely need to know about. So let's start with a really simple idea. Have you ever wanted to be the bank? Because when it comes right down to it, when you buy a bond, that's exactly what you're doing. You're the one lending the money. Yeah, at its absolute core, a bond is just a loan. It's you giving your money to some big entity, could be a company, could be the government, and in return, they promise to do two things. One, pay you regular interest payments, and two, at the very end, give you all of your original money back. It's really as simple as that. All right, so to really get a handle on bonds, you gotta learn the lingo, right? Let's break down the most important terms you'll hear. First up, you've got par value. You'll also hear it called face value. Think of this as the principal on your loan. It's the amount you're going to get back when the bond matures. That's just a fancy way of saying when the loan is due. And for most corporate bonds, this is usually a nice clean $1,000. Okay, next up is the coupon rate. This is super important. It's the fixed interest rate the borrower promises to pay you every single year based on that par value. You can really just think of it as the rent they're paying you to use your cash. And that rate leads directly to the coupon payments. This is the good part, the actual money that shows up in your account. The math here is super straightforward. If you have a $1,000 bond with a 6% coupon rate, you're getting $60 a year. A lot of the time, they split that up, so you'd see, $30 hit your account every 6 months. Now, this is where it can get a little tricky. If you're trading a bond in the middle of an interest period, you'll see two prices, the clean price and the dirty price. The clean price is just the bond's market value, plain and simple. But the dirty price, that's the clean price plus any interest that's built up since the last payment. And guess what? The dirty price is what you actually pay. It makes sure the person selling it gets paid for the interest they've earned up to that day. Makes sense, right? Okay, so not all bonds are the same plain vanilla loan. They come in different flavors, let's call them, with special features that can kind of tilt the advantage either to you, the lender, or to the borrower. So we're going to check out 3 of the big ones you'll run into: callable, putable, and convertible bonds. Each one puts a different spin on that basic deal we've been talking about. All right, first up, callable bonds. With these, the borrower, the company, has the power. They have the right to call the bond back, basically paying off the loan early. Now, why on earth would they do that? Well, think about it. If interest rates have tanked, they can pay you off and just borrow new money much cheaper. This is a raw deal for you because now you've got your cash back and you have to go reinvest it at those crummy new low rates. But then there are putable bonds, and these completely flip the script. Now you, the investor, have the power. You can put the bond back to the company and say, hey, I want my money back early. This is a huge advantage for you, giving you a ton of flexibility. And because it's so valuable, these bonds usually cost a bit more. And finally, we have convertible bonds, which are this really cool hybrid. They start as a normal bond, but they give you the option to trade it in for a certain number of shares of the company's stock. So you get the safety of a bond, but you also get a lottery ticket for the upside if that company's stock just goes to the moon. Okay, so that's the mechanics, but let's get to the part we all really care about. How much money do you make and what are the risks? This is that classic tug of war between yield and risk. The quickest, easiest way to measure your return is something called current yield. Think of it as a quick snapshot in time. All you do is take the annual cash you get from the coupon and divide it by the bond's current market price, what it would cost you to buy it today. Let's put some numbers to that. Imagine there's a bond with a 5% coupon. Its face value is $1,000, but you managed to snag it on sale for only $900. Well, you're still getting that $50 a year in payments. 50 divided by your $900 cost, that gives you a current yield of 5.55%. See? It's higher than the coupon rate, all because you got it at a discount. But, for the full picture, investors look at yield to maturity, or YTM. Here's the best way to think about it. If current yield is a photo, YTM is the entire movie. It doesn't just look at today, it calculates your total return based on every single future coupon payment you'll receive, plus the gain or loss you'll have when you get that $1,000 par value back at the end. It's your true total return if you hold on for the entire ride. Okay, let's talk risk. And the number one, the absolute biggest risk you need to understand is interest rate risk. The easiest way to picture this is a seesaw. On one side, you have interest rates in the market. On the other side, you have the price of your existing bond. When market rates go up, the price of your older, lower-paying bond goes down. Why? Because it's less attractive now. But if market rates fall, your bond's locked-in payment looks amazing and its price goes up. But that's not the only thing to worry about. There's also inflation risk. This is the quiet danger that your fixed payments just won't be able to buy as much stuff in the future because prices for everything else are going up. Your purchasing power gets eroded. And of course, we can't forget about Uncle Sam. Those coupon payments, they're usually taxed as ordinary income, and that can definitely take a chunk out of your real return. So, with all these different pieces moving around, prices, yields, rates, it can feel a little overwhelming. That's why a lot of investors, especially more conservative ones, just use a really simple strategy. It's called buy and hold. And well, it's pretty much exactly what it sounds like. You buy a bond, you hold it. You don't worry about the price going up or down every day. You just sit back, collect all those coupon payments as they come in, and then when it matures, you get your original principal back. Simple. No fuss, no trading. But, and you knew there was a but coming, right? Even this super safe strategy isn't totally 100% risk-free. It's not quite a set-it-and-forget-it deal. There are still a couple of risks that linger. The first one is called reinvestment risk. Remember those coupon payments you're collecting? Well, you have to do something with that cash. And if interest rates have dropped since you bought your bond, you're now forced to reinvest that money at a lower rate of return. And yep, good old inflation risk is still hanging around, quietly eating away at how much your fixed payments are actually worth over time. You know, this quote really nails it. Bonds are fantastic for providing a steady, predictable stream of income and for diversifying a portfolio. But they're not something you can just ignore. They absolutely require you to manage and pay attention to all these risks we've been talking about. So at the end of the day, bonds promise stability, which is great. But now that you speak the language and you see the potential pitfalls, the real question I'll leave you with is this. Are you ready to watch out for those silent risks that can slowly, quietly eat away at your returns?